Some hedge fund managers make more than $1 billion a year. That's more than the CEOs of Google, Apple, and Amazon combined. They manage more money than the GDP of some entire nations, influence markets with a single trade, and somehow make billions even when everyone else is losing. They've been behind some of the biggest scandals in history: insider trading, market manipulation, and even our good friend Jeffrey Epstein supposedly ran one. So, what actually are hedge funds? How do they work? How do you join one? And how do they make money even when they lose? By the end of this video, you'll understand how hedge funds became the most powerful and mysterious institutions in modern finance. Let's dive in. In one sentence, a hedge fund takes money from rich people and institutions, like pension funds or endowments, and invests it across a wide range of assets. Sounds simple, right? Except that hedge funds aren't your average investment vehicles. They're the market wizards, expected to make money in any condition. If markets boom, they outperform. If markets crash, they somehow profit from the wreckage. Their unwritten rule: never lose money. Three main things make hedge funds unique. 1. They're for the rich only. Hedge funds can only take accredited investors, meaning you need a net worth of at least $1 million or make over $200,000 a year. 2. They're lightly regulated. Hedge funds operate in the shadows. They don't have to disclose trades until they file quarterly reports, making them the cowboys of modern finance. 3. They're high risk, high reward. Unlike traditional funds, hedge funds can short stocks, use leverage, and play with complex derivatives that most investors can't even spell. Let's unpack some key tools in the hedge fund playbook. Short selling. Think a stock is going down? Hedge funds bet against it. For example, imagine Apple stock is $100. A hedge fund borrows shares, sells them, pockets the $100, and waits. If Apple drops to $80, they buy it back, return the borrowed shares, and keep the $20 profit. If Apple rises instead, they lose money. But when executed smartly, shorting becomes a powerful weapon during market crashes. Leverage. This is using borrowed money to multiply gains. If a hedge fund has $1 billion and borrows another $10 billion to trade, their profits and losses explode. As Warren Buffett once said, if you're smart, you don't need leverage. If you're dumb, you shouldn't use it. Hedge funds use it anyway. Derivatives. Futures, options, swaps. All instruments whose value depends on something else. They're like financial side bets. You can make or lose millions without ever owning the actual asset. These tools let hedge funds make money from almost any scenario: rising prices, falling prices, or pure chaos. Why hedge funds always win? Here's the beauty of the business. Hedge funds get paid whether they win or lose. Their typical fee model is called 2 and 20. That's 2% of all assets under management plus 20% of profits. So if you manage $10 billion, you're pocketing $200 million a year just for showing up. And if you crush the market, you take home hundreds of millions more. Take Citadel, for instance. They manage about $65 billion in capital. That 2% management fee alone earns them $1.3 billion before even placing a single trade. That's how hedge fund managers can buy yachts while your mutual fund manager eats instant noodles. Common hedge fund strategies. 1. Long-short equity. The OG strategy. Buy undervalued stocks, short overvalued ones, and hedge your bets. If Microsoft rises while Tesla falls, you win on both sides. It's the original idea behind the word hedge, to protect against market-wide crashes while still chasing returns. 2. Global macro. These are the world's biggest gamblers. They bet on massive global events: wars, inflation, interest rates, and elections. The most legendary example? George Soros in 1992. The UK tried to keep the British pound fixed to the German mark. Soros smelled weakness. His fund borrowed billions of pounds and dumped them on the market. When the pound collapsed on Black Wednesday, Soros pocketed $1 billion in one day. He literally broke the Bank of England and changed currency trading forever. 3. Quant funds. Quantitative hedge funds use algorithms and AI to make thousands of trades per second. Their goal: exploit micro inefficiencies invisible to humans. Meet Jim Simons, the former NSA codebreaker and founder of Renaissance Technologies. His Medallion fund averaged 66% annual returns for decades, making it the most profitable hedge fund in history. If you'd invested $1,000 with him in 1988, it'd be worth around $140 million today. 4. Event-driven funds. These funds profit from major news, mergers, lawsuits, and bankruptcies. When Elon Musk announced he'd buy Twitter, some hedge funds shorted the stock, betting the deal would fall apart. Others went long and made millions when it actually went through. It's like financial chess, predicting how the world will react before it happens. The titans of the game. Let's talk about the players. Ken Griffin started trading at Harvard using a satellite dish to get livestock data. Today, his fund Citadel manages $65 billion and earned a record $16 billion in profits in 2022, the largest one-year gain in hedge fund history. Dalio, founder of Bridgewater Associates, built the largest hedge fund in the world, managing over $125 billion. His all-weather portfolio is designed to make money in any economy. His workplace culture? Brutal honesty. Every meeting is recorded. Every employee can challenge anyone, even Dalio himself. Steve Cohen, the inspiration for the show Billions, ran SAC Capital, which made billions through aggressive trading and later got caught for insider trading. His firm was fined $1.8 billion, one of the biggest penalties in history. He paid, rebranded as Point72, and is now back managing over $30 billion and owns the New York Mets. Because why not? Bill Ackman, meanwhile, runs Pershing Square Capital, known for making loud, controversial bets. In 2012, he shorted Herbalife for $1 billion, calling it a pyramid scheme. Fellow billionaire Carl Icahn took the opposite side and humiliated Ackman on live TV. Icahn made a fortune. Ackman lost hundreds of millions. Not all of them win. For every hedge fund that conquers Wall Street, there's one that crashes spectacularly, proving that genius and greed often share the same office. The most infamous collapse was Long-Term Capital Management, LTCM, in 1998. Founded by Nobel Prize-winning economists, LTCM believed they had mathematically conquered risk. Using massive leverage, borrowing $30 for every one they actually owned, they printed profits until Russia defaulted on its debt. Their risk-free model imploded overnight, vaporizing billions and threatening the global financial system itself. The Federal Reserve had to organize a $3.6 billion bailout to stop a total meltdown. Then came Amaranth Advisors in 2006, a fund that bet big on natural gas futures. When prices swung the wrong way, it lost $6.6 billion in a single week. Even giants like Archegos Capital in 2021 proved how quickly leverage can destroy an empire, wiping out over $20 billion and shaking major banks like Credit Suisse. When hedge funds fail, they don't just ruin their investors, they can destabilize markets, trigger bank losses, and even require government intervention. It's the dark side of brilliance. The same tools that make hedge funds powerful can also make them catastrophically fragile. So, how do you actually break into this secret world of billion-dollar trades and 3 a.m. stress? First, you need the right foundation, and that usually means an elite education. We're talking Harvard, Wharton, MIT, or Oxford. A degree in finance, economics, mathematics, or computer science is your golden ticket. But a diploma alone won't get you in the door. Hedge funds want killers, people who can think fast, take risks, and defend their ideas under fire. Most recruits start on Wall Street grinding 80-hour weeks at Goldman Sachs, JP Morgan, or Morgan Stanley before networking their way into a hedge fund. This is known as the Wall Street pipeline. Investment banking is your boot camp. Hedge funds are the war. Interviews are brutal. You'll get hit with questions like, if I gave you $100 million right now, what's your first trade? There's no right answer. They're testing how you think. For quantitative funds, expect PhD-level math and algorithmic puzzles. For traditional funds, expect high-stakes logic and conviction. At the end of the day, hedge funds don't hire resumes, they hire results. If you can make them money, you're in. If not, you're forgotten. Hedge funds sit at the intersection of genius and greed, where data, ego, and billions collide. They are the invisible engines behind modern finance, quietly shaping markets, moving currencies, and influencing everything from oil prices to national debt. Some see them as the pinnacle of human intelligence, others as the reason the system feels rigged. And maybe both are true. Because the truth is, hedge funds are built on a paradox. The same innovation that fuels prosperity can also spark collapse. One brilliant algorithm, one over-leveraged bet, or one misplaced decimal can decide whether you make history or destroy it. At their best, hedge funds embody mastery, disciplined, calculated, relentless. At their worst, they gamble with economies while the world watches. So, are hedge funds brilliant innovators or dangerous power brokers? That's for you to decide. Drop your thoughts below, hit subscribe, and join us next time as we uncover another corner of the financial world, where fortunes are made, empires fall, and the game never really ends.